Hey, everybody, welcome to our webinar today, the Shelf Intelligence Report, Rebuilding Retail Relationships Through Automation. My name is Greg Busick, President and Chief AI Officer at IHL Group. And with me today, Lee, why don't you introduce yourself, and then we'll let Randy and Tim introduce themselves.
Okay, my name is Lee Holman. I'm the lead retail analyst at IHL.
Go ahead, Randy.
My name is Randy Wilson. I'm CEO of Shelf Optics.
And I'm Tim Preve. I run strategic accounts for retail and CPG here at Brain Corporation.
All right, super. Hey guys, chat's open on the side. So thanks for joining today. Just let us know where you are. That's the way we know that you guys are engaged and what's going on. I want to thank once again Brain Corporation for sponsoring this along with Shelf Optics. This makes this content available to you guys for free. We're so grateful for them. This helps keeps the lights on for IHL during these challenging times. Also wanted to share a couple just quick commercials about IHL. We've changed the Ask IHL Analyst to just Ask Greg. It's got my voice on it, but it's all the collective knowledge of IHL that's available to you guys in a chat bot for strategizing, account planning, deck views, just basically having an analyst on your team 24/7. You can do that through Ask Greg. Next, how's your NRF planning going? For those that are vendors on the call, there's a ton of stuff going on right now with NRF. How's your lead gen targeted list? We've got a list of likely attendees for NRF that's been curated. Even how to drive attendees to your booth. We've got offerings there we wanted to let you know about. And then finally, our ClearSight AI. If we can help you guys deploy AI in your company, we've got over 400 use cases and a process that can greatly streamline what's going on with AI within your organization. How do you get from just a little bit of optimization of what you're doing to true innovation where you can bring up to 10x improvement in what's going on? And with that, we're going to turn the cameras off and get into the data. I am going to go through a lot of slides very quickly, guys. I've got basically a slide every 20 seconds. So just quick on the election last night. Looks like the Democrats won many of the major parties. I don't know all of them, but certainly mayor of New York, and then governors in Virginia and New Jersey being the big ones. What that means is I think we may get to a resolution of this standoff this week regarding the government shutdown, which would be a huge win for us as we go forward. Let's talk about inflation first. Okay, CPI was the one number we got out of the government this month. They're had it at 3% for both the overall as well as what they call the core inflation. However, if we look at it in more detail, we see that there are still some projects and products where we're seeing a great increase in cost across the board. Coffee being the number one with the heavy tariffs that are coming from Latin America and South America on the coffee. So I'll quickly go through these charts because I think there's some problems still with what's going on with the overall CPI as it's coming out from the government, as I mentioned. So right now, if you look at the data overall, the half twos are at about 2.5%. And if you strip out the shelter number, which is now becoming a little bit more in line with what's reality out there, we're at 2.2%. However, there is a huge disconnect that remains in the CPI. And this is the one number that is the most observed. And I thank Charlie Belalo for this chart. Charlie does a terrific job, but basically the government thinks that health insurance has declined 18% over the last 5 years. But what does the real data show? It shows this, and this is what we're going and looking at. And this is through 2025. The 2026 numbers obviously are going to be much higher. That's a big part of what the shutdown is all about. There's still a disconnect on these government numbers and what's reality. That's why we greatly prefer Truflation. It's a much more accurate number on the Truflation index rather than the CPI, which now has us at about 2.7, which is getting closer to where it has been. It's been off as much as a full percentage point of what Truflation was seeing in real time versus what the government data was showing. All right, gas prices are always critical. We're now just over $3 a gallon. Prices continue to come down. And overall, the price of premium and then diesel, if you look at diesel, hasn't changed that much from year to year. And that is a concern as we look at things going forward. So where are we as states? We are literally in a recession in many states around the country. And this was prior to the shutdown. So you'll see some of these yellow areas where we're going to see maybe some of these things slip into recession territory with the shutdown. Now, the shutdown, we estimate, I heard estimates this morning that basically every week is about $15 billion in GDP that is lost for good from the shutdown. You add basically 1.6 or 1.5 to that, get you the flow of that through the economy. We are looking at roughly $75 billion lost in GDP so far from the government spend. That spend as well, when you go through what flows through the economy, you're going to multiply that. So we're looking at $100 to $125 billion in spend that flows through the economy as a result. So I took the research on this economic ripple effect of government spending to look at how does that flow through the economy. And you can see all these different ways it flows through the economy there, but it actually filters through that specific private sectors like retailers and restaurants as it's most applicable to us. Some of this will come back as people get paid from the government. Some of it's going to be lost forever. You're not going to eat more in the future just because you didn't spend your money on groceries to the same degree this you're not going to eat out at restaurants more because you didn't eat this month. So that is probably gone for good. But other areas and other segments may see that money come back once the government data is in place. One of the good news is rent is down overall, and we've been down below the 0% compared to where we were in January of 18. We're negative and rents are coming down the last year. That's a positive. Contributions to GDP spending, second quarter real GDP was up 3.8%, which just shows you here over time what GDP looks like. However, the thing to point out is retail was really not contributing. We were a detractor in the second quarter of GDP. So when we look at GDP improvements or what's going on here, it is highly, highly focused on insurance, and that is insurance related to cars and insurance related to autos and insurance related to health. That is driving the growth in GDP right now. And this came out from a Harvard economist basically said without data center growth, we would be flat in GDP for the first half of 2025. So it's not just the stock market, it's the investment overall through the economy. Some good news came out this morning. AP announced that private payrolls rose 42,000 when they were expecting a decline. We saw a decline in September of 29,000 jobs. The fact that those went back positive is a very good news story. We don't know how many of those new private payrolls increased because government payrolls decreased. We don't know that answer yet, but the fact that this number is positive is a good news story for the economy. Job openings, though, slumped to the lowest level since February of 21, according to Indeed. So that's going to be tough to maintain that growth level there that ADP reported this morning as a result of things. The part that's getting hit hard are those starter jobs, those coming out of college jobs, and we'll talk about that in a second. This was a chart I thought you guys would like. It just kind of shows you what unemployment rates are around the country right now based on where your state. Go ahead and throw in the chat. Tell us where you're from. What color is your unemployment there for that? But here I am in Tennessee at 3.6% unemployment right now, according to this chart. So what's happening is the number of job openings has decreased to the level that we have unemployed folks. We had about a 5 million job differential that was in place previously to that. The disconnect is the jobs that are open are either underemployment for those with the skills that they have, or they simply do not have the right skills for what's going on. So that's where we're having considerable unemployment overall. And where the greatest underemployment is right now is new grads that are college educated. If there's any bubble in the economy right now, it is related to college tuition and the resulting jobs that people can get. And this thing hit and changed dramatically in the last 2 years. In fact, full-time jobs in the field that you graduated from for new grads in 2025 dropped to 30%. Just an incredible drop from where we've been in the past, and a complete switch of what the world was just a few years ago. Just a few years ago, get a STEM degree, get a data science degree, that's your ticket. All of that's been flipped on its head with AI now. And this has greatly slowed the job market. This is critical because that job market ends up spending a lot on retail. Debt is going up. There, we're up to $18.39 trillion in household debt. That's mostly related to mortgage debt growing, as well as student loan debt picking back up. But you see it's growing pretty much everywhere along the way, auto loans as well, and credit card debt. The number of accounts has also gone up dramatically, particularly credit cards. Now, we're not stressed. The consumer's not stressed from a debt load like we saw in the financial recession. However, that amount of open accounts has gone up significantly over the last several years. The cost of a house has gone up to about 47% of your paycheck from where it was when I was growing up at about 28%. They said that your house, your PMI, your insurance, your taxes, all that stuff should not be more than 28% of your income. That's simply not realistic anymore. And that filters through the economy in a big way. We've got an affordability gap between the income needed to buy an actual home and the actual income of the consumers. And as I mentioned, that filters through things, particularly when you start factoring in that only 24% of homes now are bought by first-time home buyers who have to buy everything to outfit their home. So that is a big problem that we're dealing with today. Some good news, interest rates are starting to come down. The Fed is slowly lowering rates, which is starting to lower rates of new loans. We're down into the 5s and 6s now when we were in 7s and 8s. Just a couple months ago. So that's $200 more savings in a consumer's wallet than we had a couple months ago for items. This is the forecast for the Fed rates to come down. I expect these to be down almost a full point at least by the time we get to May of next year. But it's probably too little too late to help the economy at this point in time, particularly for the holidays. Consumer expectations and consumer sentiment is at a really low point right now. As we've mentioned, the tariffs and all the stuff, the negative stuff in the economy right now. We're getting all the negative stuff now. Any of the positive happens in 2026 when people start to get their tax returns and realize that their taxes are much lower than what they have been. Consumer sentiment, the part that's most concerning here is the higher income group that dropped considerably in the last 2 months from where it was. That is a concern because, as we'll see here, up to 50% of the retail economy is driven by the higher incomes. And just as a quick aside to tell you a quick story, my wife yesterday, she volunteered at a local food bank that we have with some friends. They packed generally these are certain bags of stuff that have these essentials in it for their outreach. Generally, they do 7,500 a year of this one bag that has these particular goods. They've already distributed 14,000 this month alone as a result of the closing and the reduction in the SNAP benefits. That is a big issue that's happening at the lower, and we really have what they call a K-shaped economy right now. The higher incomes, if you have stocks, that's still been going up. If you own a home, that's still been going up slightly. If you're not in that mode, everything's negative, and your income and your real purchasing power has dropped dramatically. And so when we look back here and we look at this drop in $100,000 incomes or higher, that is a concern as we look at retail overall. But with all that negative news, retail is still up. This is real credit card data that shows us up 5.5%. You take out 3% of inflation, and you have a little bit of retail therapy that's happening in the market out. These are the categories specifically. I'll just go through these really short. Just clothing and accessories. The back to school season was really strong, as well as the sporting goods, the hobbies, the bookstores was really strong numbers in September data. So that was the breakout of those numbers. What the holidays look like. This is data from Affinity Credit Union. Basically, families are expected to spend about $2,830 this holiday season, which is up about 3%, according to Affinity. What's going to get hit, I think, are going to be these experiences and self-gifting. Self-gifting is about 40% of holiday spend. And self-gifting is going to be the area that sees the big drop when we come to the holiday spending. I don't think people are going to spend less on gifts for family and friends, but they are going to spend less on themselves. That's why if you sell products that are in that self-gifting mode, you better have a good business model as a buy now, pay later type of approach, or a significant amount of your sales could be impacted by the general economy. Adobe predicts that the AI-assisted online shopping is to grow 520% during the holidays. This week, Amazon announced that Rufus, their AI chatbot, has already contributed $10 billion in sales to their online sales through their AI offerings. So that's one number. And then if people started earlier this year, as once again, 65% of all holiday shopping is expected to be done before Black Friday this year, according to McKinsey. So in their surveys. Now, that might be delayed for the government due to the government shutdown. It might get pushed off a little bit further than when this was actually taken in August. Christmas and the holidays just keep getting earlier and earlier for all the things. So that all of that is a precursor to what's going on at the shelf. And that's our topic today. We're going to do a deep dive in shelf intelligence, and particularly the rebuilding the relationships. There are now three primary revenue streams. There's the standard selling products that happens in a retailer, and that can be online as well at the store. You also have the retail media networks, which is driving revenues from brands. And then you have the shelf data itself. And this is going to be a deep dive looking at the challenges that retailers face today with having accurate data on the shelf and what that can lead to in terms of increased revenue from brands to build their businesses. So let's step back a second. Let's look at AI and spending overall. It's now 16% of total IT budgets, up 29% year to year using AI in the store for all things. Key definitions real quick. We may mention leaders. We may mention laggards. A leader is somebody that had 10% or more sales growth in 2024 or 10% or more profit growth in 24. A laggard would be somebody that had flat or negative in those two metrics. So just for reference as we go forward. And this is where we're seeing a huge difference in what's happening in the economy. The sales winners, the people that grew their sales 10% or more, they are growing their IT spend at a level 4 times that of laggards, 4 times more growth than the laggards. So we're hitting the gas pedal and continuing to invest in IT, particularly AI technologies through not only at the store, but at the headquarters, and doing more automation throughout their system overall. While we talk about e-commerce growth and all that sort of stuff, you have to remember 87% of all retail revenues have some sort of store component of being fulfillment. Whether it's BOPUS, click and collect, ship from store, local delivery for those e-commerce offerings, or the traditional just walk-in customer that comes in the store. So the stores remain critical for what's going on. Overstocks and out of stocks, having in stock what the person wants to buy when they want to buy it is absolutely crucial. And it's a huge disconnect in our market overall. In fact, I believe it's close to 6% of all retail sales worldwide is misjointed because of overstocks and out of stocks there. And we're losing money in individual retailers as a result of these overstocks and out of stocks. We also have huge problems with inventory accuracy. We see that 67% of our sample have problems with their inventory accuracy at a weekly level or higher. We did a survey of 300 different brands here focused on fast-moving consumer goods and specialty stores in particular. And these were the results of what we've got here. Inventory is a problem for everybody. Nobody has got it completely licked. However, there are technologies that can tremendously help in moving things forward and improving that relationship. The fastest growing retailers, they're actually showing a higher concern about their strained relationships with the brands. They're growing their sales, but they're having all kinds of problems due to theft, due to just normal shrink within the organization, and due to problems with shippers not getting product there when they need to get that product there on time. Delays in the logistics process. They are rating this as an 87% higher concern. And we can see there are differences that are happening that as you go through it, the larger retailers are having the biggest battle when it comes to this. $5 billion and plus, they're saying 32% reported that we have constant inventory issues there daily or near daily, and another 36% having those issues on a weekly basis. Same with the 1 to 5 billion. We'll see that they're sort of a sweet spot for this automation technology because of the issues there. Weekly problems, but 17% constantly there. And then the under $1 billion retailers, less often situation, but still having really high, we're looking at 61% having at least weekly problems for the smaller retailers on that inventory accuracy. And this is impacting the relationships with the brands. 65% of the people in our survey said that the inventory inaccuracy is affecting the relationships with their key product providers, their brands. And the lack of that good information and accurate information is causing issues when it comes to the actual feedback and the cashback from those companies. So that is a big problem. It's why we're talking about it today. So I want to invite in Randy and Tim to take it over and talk about the shelf optics solution.
Thanks, Greg. I'm going to just pull up a few slides here to give you an overview on who Brain and Shelf Optics are with Randy, and then we'll actually dig a little bit into what this solution looks like in terms of being able to provide robotics at scale for all retail formats. Randy, I'm going to just turn this over to you to just going to describe Shelf Optics and the vision that you had around robotic scanning.
Thanks, Tim. Thanks, Greg. This is kind of a slide that whenever we think about the flywheel of retail, this is really kind of the flywheel. Whenever we think about robotics, we think about scan, insights, action. I mean, it's really a 3-step process of being able to scan the store, understand in great detail what's going on at the store, provide the insights back to, be it a retailer, CPG, supplier, consulting agency, be able to provide that data back in an insightful way for them to be able to action on those. And then the action is really being able to integrate back with store systems. I actually own another company called Driveline Retail that we have about 15,000 associates across the country. And so we tie those insights back into our national team. But that flywheel really addresses the issues that Greg just brought up. Whenever you think about OSA as a whole, relative to planogram inconsistencies, out of stocks, chronic out of stocks, phantom inventory, all of those issues that we all deal with every day. That's really kind of our flywheel for that. Then whenever you look at, you can go ahead, Tim. It's okay.
No, go ahead, Randy. I'm sorry.
No, it's all right. Go ahead.
Yeah, so we partnered, and Randy came to Brain to partner with us in terms of delivering a robot that is able to effectively provide robotic scanning for all store formats and sizes, and to make it economical. So at Brain, we have 40,000 robots deployed worldwide. We work with the largest retailers in the world. We are trusted as safe and secure by them to deliver robotic scanning at scale.
Yeah, whenever you think about robotics at scale, we started off, the whole idea came from the fact that small format, probably anybody, we're in Bentonville today, but anybody smaller than a large mass is going to struggle to be able to maintain a full-time robot in a store. So the idea that we came to was really being able to syndicate those robots across stores to be able to reduce the cost, reduce the capital outlay, reduce the drag on the stores. And so that's where my partnership with Brain came from.
And Randy, I think I'd cut you off when you started to walk into some of the key components on OSA and the challenge around OSA that Greg had brought up in his deck here. And maybe you just want to cover these quickly.
Yeah, whenever we'll get into kind of the resolution opportunities and some of that sort of thing a little bit later. But we kind of think of this as scanning as a service, which makes it very flexible for our customers, for them to be able to scan stores that need to be scanned, don't spend time on stores that don't need to be scanned. Being able to address all of those issues on the right-hand side, you're looking at everything from, again, the basics of OSA all the way up to display and promotional compliance. Ability to be able to see realograms within the store, to be able to understand what the store actually looks like. And that's both from a data standpoint as well as a visualization standpoint. And then this ties back to another tool that we have, which is a full-blown mapping tool that we'll talk about a little bit later. But to be able to map your stores all the way down to the fixture planogram item level.
I'm just going to give you a little bit of a feel right now for what the form factor looks like. And at Brain, I mentioned we have multiple different form factors, but this is a form factor that was really geared toward providing that scanning as a service capability. This is a very brief video that will show you what the process is, This takes about 4 minutes to get out of the vehicle, to get set up, to begin scanning, and basically operates very efficiently, very quickly. The whole idea is to get in and out of the store as quickly as possible. And as you can see here, what you're looking at is just some realogram images that are captured by the robot. And we'll go into a little bit more of those next, another short video that we have to actually show you what the robot sees when the robot actually is operating in store. So in this particular video here, what you see is you can look at full store. As Randy mentioned, there's mapping capabilities, and so you can map the store, and then based on that, select an aisle in the store to look at. In this particular case, you're looking at a stitched image. What you're seeing there highlighted in red is actually an out-of-stock situation. And if you look at the first one, that there's an out-of-stock on a regular price item. You can see the price detection over to the right. Just next to it is actually another out-of-stock, and this is an out-of-stock actually that's on a promotional item. So this was recognized, the price tag recognized the out-of-stock, and then recognized the actual, that it was actually on promotion. And so we can then go back into the map, and this particular time we can select an end cap, for example. And on this end cap, what you'll see is that you'll read a price tag, and the price tag actually shows that this should be a 194 ounce liquid gain. But what you see when you look at the shelf, you actually see that the end cap is set incorrectly. And so you're seeing a different product of liquid gain that's actually on that shelf that is priced differently and should be located elsewhere within the end cap. And then finally, we talked about full store. So you're able to basically scan any item within the store. And in this particular case, this is a condiment aisle. And every one of those blue boxes you see is a product detection, accurately detected the product, what the product was, what the G10 is in the product, and then what the price on that product is. That just gives you an idea for what the actual robot saw when it was scanning. Now, all of those insights are delivered in a format that are digestible. So you might want to look at those insights by scan. You may want to look at them by store. You may want to look at them by SKU. Look at them by store cluster, by category, across store cluster. And those can be ranked in terms of helping to target specific activities that will provide the most impact to improve the business and move the needle in terms of ROI. And Randy, I'm going to turn this back over to you to talk about what we've seen around image capture.
Yeah, what we've seen is we've heard from, 6 of the major retailers in the U.S. that for the most part, they have tested robotics in the past. And the biggest issue always is resolution. And whether that's glare, from a plastic strip or from from the price tag itself, whether it's lighting within the store, whether it's shelf configuration, what we were able to show them is the ability to be able to capture at a resolution that nobody else can capture. And so whenever you're looking at this price label from a Fritos product, whenever you look at that, not only can you see that from a scanning perspective, we pick up pricing, we OCR all of the information off the tag, we read the barcode on the tag. You can even see whenever the tag was actually placed on the shelf, whenever the tag was printed. So now you can check project completion, you can check overall, planogram accuracy off of that, even from the tags on the dates, the dates on the tags. So, and then when we roll that back into a formalized dashboard that allows you to be able to see, pricing issues, stock issues, chronic out of stock issues, because what we find is that we continually find that if an item is out of stock frequently, it becomes a chronic problem. As the algorithms on the order management side start to run down the order quantities on that, you just consistently make that problem worse. And so we provide that back in a format that's really easy to digest, as well as we provide that back on the store's handhelds, your field team's handhelds, so we can integrate back into your mobile app on that side.
And Randy, I think, can you see the case study there?
Yes. Yeah, we've done a large scale project for the largest CPG in the world. We have done a large scale program for them in the dollar channel. And the dollar channel has probably suffered more from shrink, which has resulted in tremendous phantom inventory, a lot of damages that seem to be coming through not only the DC, but in direct to store shipments. We see a lot of damages on that side. So they came to us 2.5 years ago and said, here's the issue that we have. We continue to see declining sales, more shrink, more markdown dollars, more marketing funds going back into this. So we've got to figure out a solution. So what we did is that we applied the algorithms on our side. We built out a lot of AI around this whole process to consistently and constantly monitor their data. And what we saw was we immediately saw an increase of a little over 20% in overall unit movement. And we're more focused on unit movement than what we are retails and actual dollar movement at this point because, OSA is really made up of units of having the right product there at the right time. So we continue to provide this service for them, and now we've expanded that to a number of other suppliers. And we actually provide suggested orders back to the retailer every Thursday. So that is really what the results can be whenever you apply the technology.
I think it's important also to note that this has remained consistent for the past 18 months. So that gain has been consistent and continuing. So it's more than just a one-time gain. Is there anything else that you'd want to add, Randy?
Yeah, I think that's it.
Yeah, I think that was all that we had, Greg, in terms of sharing slides.
Great, guys. Thanks so much for sharing. Hey, real quick before you jump off here, the 20% increase in units, could you delve into that a little bit more? Is that sell-through? How is the 20% calculated, and what is that?
Totally sell-through, and just in round numbers, they were selling, whenever we started this process, they were selling about 6.5 million units a week, just in overall round numbers. We immediately moved that to 7.5 million, and then
Wow.
we moved that to 8 million within the first 120 days or so. And that has continued to grow, and their target there is 9.4 million units a week. And right now we're running about 8.6.
Wow.
So we still have some work to do for sure, but
Wow.
we continue to work on it every week.
And I think just one other point I'll make there, Randy and Greg, is that it shows that the concept of ground truth is a signal that is not factored into even the most sophisticated forecasting, replenishment algorithms, and artificial intelligence models. So it's being lost and it's not being picked up. And the ability to actually scan consistently, whether through a continuity program or through one-time projects, allows you to pick up that signal and understand what signal has been missing.
Well, and Greg, I think that one other thing around that program is we run one of the larger manual capture image recognition programs in the country. And this is also what kind of pushed me towards looking for a different solution, is the fact that we get about 85% compliance relative to photos that are usable coming back from reps, that manual collection process. So with the robot, we effectively get 100% of the entire store, not just 85% of a specific category. So the impact is massive across the store.
Yeah, that's outstanding. That's outstanding. Here we've been working together for 3 months here on this project, and I didn't even know those numbers. So thank you. All right, let's get back to the numbers about the research related. So we ended on a brand trust discussion here on the numbers. Let's dive a little deeper. One step here. If you've got questions, please start to put those in the chat so we can get those questions about the solution or about the data, and we'll have that here in just a few minutes. But brand trust overall, there's like a hole in that $1 to $5 billion range. Overall, we're at 69% in the survey sample of 300 brands. But there's a hole in that $1 to $5 billion range, really struggling. The highest level of brand trust is at the largest of the retailers at 74%. And the lowest is actually that 1 to 5, not the below $1 billion retailers that is causing the issue. So that brand trust, increasing that brand trust increases trade dollars, increases the opportunity to monetize that shelf data as another revenue stream for the retailer. Retailers that had over 70% on-shelf availability actually had 18% higher brand trust ratings. That makes sense. The data coming through made sense that literally the higher your on-shelf availability, the higher the brand trust that came into play. And that's the problem with what's happening with out of stocks in particular is customers will give you about 2 to 3 times to get it right before they write you off for the overall that product category. And we see it remarkably higher for those that are Amazon Prime members, which is now over 80% of US households. Basically, what happens if they come to a physical store and you don't have it, they simply whip out their phones and start ordering it from Prime, and they're likely to continue to have a subscription for that item as that goes forward, just because it's always available from somebody on Amazon in most cases, whereas my local store may not have it and I expected you to have it. So this is a bad crisis that retailers are facing with the data. This is the ratings on that we saw in terms of promotional compliance accuracy, on-shelf availability accuracy, and planogram accuracy across everything. And we can see in every case, it's over 40% or more that is inaccurate. And this is a problem that once again, physical retail is having more and more of, because it's becoming more compelling to just buy online and have it delivered for a lot of things because of this inaccuracy. And that's why it's so critical to get this inventory accuracy fixed. And the reality of it is we think we're better than we are, and that's the problem. Retailers think they're in stock at 92%. And the reality of it is they're not. Employees know it, consumers know it, and that's causing a huge problem. It's become even more difficult with theft, as well as items being locked up into the store there that people can't get to. So those are all major concerns that inventory accuracies comes into play. Literally a third of retailers rate their promotional compliance at less than 50%. So these are the items that you're getting the trade dollars for to put on end caps, but less than 50% compliant on those particular areas. A lot of times that has to do with not having the labor to be able to do it. Other times you just simply run out. You have good problems where you sell through it all. But most likely it's because the items are sitting in the back and they're not getting out to the front of the store where they can be sold. And that's a huge issue that's happening in retailers. Only 1 in 5 retailers reach a self-rated 80% compliance in any of these categories. So only 20%, I think it's 22% is the actual number there, say that they've hit 80% in any of these categories. So what are the technologies that are improving the inventory accuracy the most according to our survey? It was robotics was number 1 at 52%, handheld RFID readers at 47%, using the phone doing images at 42%, fixed cameras at 38%, and handheld bar scanners there at 35%. You may be asking, where is perpetual RFID? It was actually too few people were doing it to have an actual answer there, but it was below these top things overall. So number 1 by a significant amount here was robotics at the store level, which is just happens to be our topic today. What are the ideal number of times you should check your inventory? This was a fascinating data point as we were looking at things. Basically, multiple times a week or daily or once a week dominated everything. But really looking at 1 to 2, 3 times a week being the sweet spot. They said 76% said multiple times a week, at least once, but multiple times a week. And actually, you'd go to 89%, 88, 89% if you factored in the daily. So it's at least weekly here. And in most cases, it's 2 to 3 times a week. And that kind of gets to the solution that Brain Corp is offering here, is this bring the robot onto the actual sales floor a couple times a week to do that inventory, rather than having one that's scanning every day throughout your store if you don't need that. 88% of retailers, as mentioned, one at least once a week. How do you do this? I already saw the questions coming in here. How do you go about doing this if the real optimal time is a couple times a week, but not every day? And that is the general view, is the survey respondents want this as a service. They want this platform as a service thing. 67% of our survey respondents said they wanted it that way, particularly those under $1 billion. They couldn't afford to do that. What I found interesting is that 1 to 5 billion, those people were more likely to say they want to own the robot than we saw in the other income levels. So that was really fascinating to me to see that. That's the group, once again, that has the lowest compliance, but they're looking maybe more towards owning it. But still, the vast majority overall is looking at a robot as a service offering. So One thing we did find out in this study is the question is not whether robots belong in retail or whether it would be accepted in retail anymore. It's how fast can we get them there. So the biggest drive, though, for robotics and the model of getting to a robot as a service type of approach is not the financial cost of owning the robot. It's the lack of in-house workforce to manage the robotics at the store level. They just simply do not have the people to be able to do that. That became very, very clear in the research there. Strong adoption of this technology as we're going forward. 60% of the fast-moving consumer goods retailers, which is in our case would be everything from grocery stores, drug stores, mass merchants, and convenience stores and warehouse clubs. 60% of those that are over $5 billion in sales plan to deploy in-store robotics by the end of 2027, according to our research. So it's fast growing simply because the return is so significant, not only in terms of monetizing that shelf edge data, but as these guys mentioned earlier, this 20% increase in the number of units that are moving as a result of having that accurate inventory is just incredibly compelling data to add to our own research. And so what happens here is we've looked at what happens when there are inventory issues related, and you get this virtual cycle that starts to happen within your organization. The better your teamwork is around compliance. The people that have over 70% of their compliance, they show a 12% overall compliance there, but a 17% higher brand trust. And that creates a virtuous cycle where things start to improve as a result of that. This quote here, your inventory data is not just operational intelligence, it's untapped revenue. That's the point of our entire presentation today. We've got this third revenue stream for you on monetizing the shelf table data. The more accurate it gets, the more you can gain from the suppliers back to you in terms of income, or whether it's trade dollars or other items at the store level. This monetizing the shelf data, it becomes a critical piece of the profit equation now, particularly when we go to tariffs and we're looking at how are we passing this along or not passing along these costs to consumers. How much more can the consumer take related to these product increases and inflation? The opportunity to increase that revenue from shelf data is a huge opportunity for retailers in a market that is incredibly competitive, where you can go store to store to get the items based on the prices. And as the economy is bad, people shop more store to store to find those best prices. So you really have a three-part equation when it comes to what's the ROI for robotics. You've got the additional sales from compliance, you've got the shelf data monetization, and you've got the reduced labor cost. All too often, we just focus on the reduced labor costs and the additional sales focus. But the fact that you have the opportunity now to do a better job of monetizing that brand information because of that shelf intelligence and real-time inventory look is a huge opportunity to pay this cost of the robotics. And then when you add to that, it's robotics as a service type of approach. You do not have to take all that capital on to start to deploy these technologies. That being said, you cannot just deploy the robots. That was very clear in the research. 72% said you also have to integrate with our task management solution, and 65% want direct integration with their ordering and fulfillment systems. The robot just can't simply give you the inventory issue data and say thank you type of thing. It has to be fully integrated to be effective for things going forward. So who's the champion? Who makes the decision here for this? We see the CFO is a major player in this, but there isn't just one title that just dominates where the product champion is going to be in the company to manage this. We've got IT, CFO, but we also see operations and supply chain and merchandising being champions throughout this. But clearly the decision maker who you sell to is going to be the CIO and CFO and CEO. Those are by far the largest decision makers in the group. And with that, that's the end of our presentation. We want to open it up once again for chat. If you like this or didn't like this webinar, we've got a link here for you to provide feedback for you. Beth, if you wouldn't mind dropping in the links for where people can get the slides and the report into the chat there. Everybody can get that. And with that, I'm going to invite all the guys back on. And Lee, would you do the honors?
Yes, great. Right off the bat, let's toss a question out there that you addressed there at the very end. The data that this system throws off, is that considered to be retailer owned?
Typically, that's retailer owned.
Okay, so they can do the aggregating and then monetizing and all that without any influence from you guys.
They do. We can share data directly with them. We can provide the actual insights, but yeah, we can do it either way.
Okay, great. Let's see. This one came up. The robot, does it use cellular data or does it use the Wi-Fi in the store?
It can use either. So there's really three mechanisms. One would be store Wi-Fi. One is it is LTE enabled and cellular enabled, but also we do have private network that we've tested and successfully deployed with the grocer. So it can be any of those three.
Okay. Greg, here's one for you. Are we in an AI bubble?
Jeez.
It looks like .com.
It is a great talking point. .com, what caused the .com thing was the build out of fiber. We had this massive build out of fiber that occurred. Plus, we had these incredibly poor business models that were out. 97% of the fiber that was laid in America was dark. It was for a rainy day. When it comes to AI, there are no dark GPUs. We are using everything that we can get our hands on at the data center. We're still in the first inning here for these things. Yes, there's going to be a bubble in some areas at some point. But right now, I think if there's a risk of a bubble, is the fact that companies cannot change their business processes fast enough to take advantage of the technology. If there's a risk, it's we build out the data services and the companies haven't been able to change their business processes to do it. So basically, if you want optimization with AI, you can get optimization real quick, a 10 to 20% improvement. But if you really want that 10 times improvement, you have to redo the process with AI in the front of that. And that how fast you can do that is the big problem with that.
Okay. Randy and Tim, the robot, can it scan and do facial recognition to identify crooks?
We actually anonymize any type of facial recognition with the robot, and we've been doing that for many, many years since the inception. So we don't want to be in the business of providing facial recognition data, but we do blur faces for all people that are encountered.
Gotcha. Greg, I think you touched on this earlier, but somebody asked, due to the shutdown, which segments will be hurt permanently and which will probably recover once people get paid?
I think grocery for the fast moving consumer goods space it's gonna be tough. It's just because you spent less on food last month doesn't mean you're going to spend and eat more the next month. You're not going to go out to eat to restaurants more because you didn't last month there as a result. I think when it comes to other segments, when it comes to more household goods and that sort of thing, that will become something that recovers as a result of this. And it won't be a forever loss, but I think it's a challenge because of the loss is the loss. And you don't go back and regain more food type of things. Now, you may see some brand recovery for things as a result of that, but it's not like the overall number just, makes up for last month.
Yeah. Okay. Randy and Tim, is this type of setup proving a really strong ROI across a number of retail segments, or is it just mainly focused at the mass merchant, grocery, that kind of thing?
Randy, do you want to take that?
Yeah. I think that whenever you look at that, Lee, we are piloting this thing in basically all channels at this point. That's everything from dollar, convenience, all the way up to mass.
Okay.
And the ROI, is pretty easily calculated. We provide that back as part of the data, as part of the insights to better understand that ROI. And so, Greg had mentioned a few minutes ago kind of a measure that you guys had developed internally around inflation, et cetera, et cetera. We've kind of developed the same thing around OSA. We call it real OSA. And real OSA really runs back against that in-stock number that most retailers look at. They go, great, man, we're at 94%, we're perfect, we're right on. But whenever you run the real number, you're in the low 80s or high 70s, and it's an issue.
Okay. This is to you guys also. The robot, is it owned and operated by the store, or is this platform as a service thing that you guys offer?
No, it's totally owned by Shelf Optics, and it's totally owned by Shelf Optics, and the robots are deployed by Shelf Optics. Whenever we come to the store, what we strive to do, one of the unique benefits around our product is that the robot is always escorted. So, retailers always have a worry around the interaction with customers, interaction with store employees, et cetera, from just the robot running around the store. Our robot is always escorted by what we would term a robot wrangler. And so he is always with that robot to be able to soothe any customer issues, make sure that we've got everything covered.
Does he come with chaps, the
I'm
Wrangler?
sorry.
Does he come with chaps? I'm sorry.
So I know Richard's on here. Richard, see, you're not going to be able to annoy the robots anymore because you've got somebody there that can take care of it.
This one's for Randy. What are 3 or 4 challenges that on-shelf availability is solved by using these robots?
A couple of the biggest ones clearly are out of stocks and chronic out of stocks. That's probably the number one issue. But then whenever you roll into phantom inventory, where you think you've got product on hand, but the shelf is bare, that's probably number 2. Whenever you think about planogram compliance, most retailers don't update their planograms. Smaller format stores especially don't update their planograms between new item cut-ins, a planogram refresh, a strip update, that sort of thing. They don't update the planogram. And so one of the benefits that the robot gives you is it basically gives you back a realogram of that category. So now you know exactly how it was set, what the facings were, what the configuration was. And then what we do is, from an insight standpoint, we actually take, based on what you think the planogram that was set, compare that back directly to the realogram of what the robot saw in the store.
Tim, this one's for you also. How long does it take to scan a store? Is it days, weeks? Do you need one robot? Do you need more than one?
Yeah, and it depends on the size of the store. So I'll just give you an example of a dollar chain store. We typically can scan a dollar chain store, anywhere in the neighborhood of 7,500 to 15,000 square feet in 2 to 3 hours. Convenience store could be scanned in 45 minutes to an hour. The traditional grocery store, let's just take a 40,000 square foot type traditional market, is typically in the 4 to 6 hour range. But if you're going to move into, like, say, the hypermarkets, 100,000 plus 150,000 square foot stores, those would take longer. So you're up above the 8 hour time frame, and you may decide to pair two robots to do a store like that.
Okay. Greg, this one's a little bit out of left field, but what do you expect the impact on retail to be with the increased healthcare insurance costs?
Well, I think those subsidies come back if the government ever reopens, or if they come to an agreement with that. We are seeing the increase in healthcare costs there. That certainly affects necessities more than wants and desires type of thing. So it could mean less for brands and more generics for folks, or just changing menus within the organization. So one of the things we're seeing a great deal this year is a huge rise in Hamburger Helper again as a choice when we see the large increases in beef prices. So you'll see those kind of changes. But overall, I think the numbers will continue to increase as wages as well as other things increase. They'll skimp on trading down on eating out or some other things before they change their eating behaviors.
Okay.
I think we've got other pressures there like Ozempic and Wegovy and that sort of thing on some of the brands that's even greater than the health insurance.
Okay.
Hey, Greg, one of the things that we see, especially in the dollar channel, is we see people move down from the larger, let's say that you're looking at Tide, for example. You will see people that will move down from 128 ounce Tide down to a 16 or a 32 ounce bottle. Instead, you'll see those sales spike during these tough economic times.
Yeah, I mean, same thing happens at the gas station. You fill up partial tank instead of a full tank as a result of that. Yep.
Yeah, and it's all over the place.
Mm-hmm.
We're a couple minutes past the hour, so let me toss it to you, Greg.
All right, super. Hey, just wanted to, last thing here, show you, for those of you attending NRF, consider the Super Saturday Day. The second hat I wear is leading the Retail Orphan Initiative. Basically, we are in the critical time of the next 2 weeks for retailers to register. Even if you're not sure you can attend, if you register, it helps us Every retailer that registers can help create $5,000 sponsorships, which is enough for a community to get clean water that doesn't have it today. So hopefully you can join us. We thank you for that. And with that, guys, that's the end of our presentation today and our webinar. Thanks so much for joining us. The slides and things are available out. Beth dropped the link in. But Beth, if you do that again, the link for people to get the slides, the report, the research as well, and as well as I'll email those out to everybody. So thank you so much. Hope you guys have a blessed day, a blessed week, and have a great weekend, everybody. Take care. Bye-bye.
Thank you.